So sorry for the audio. Now, I believe you can all hear me now. I believe this audio is fixed once and for all. So I'm just going to start from the beginning. So, let me be sure you can hear me now before I get started again, before I pick it up from the beginning again. So, please confirm you can hear my voice, confirm the volume, the audio is good, confirm you can see my screen. Please confirm that. So let me just get started once again talking about dividend investing. Let's talk about dividend investing. So we started by saying what is stock investing. I would say that stock investing means buying shares of ownership in a public company. So if it is not public, you cannot call it a shares. So those shares are called stocks. And then if your stock become more valuable, let's say you bought at $20 and then you are selling at $25, you've had capital appreciation of $5. But now we are not talking about that today. We are talking about a scenario where you get to earn quarterly, yearly, or monthly based on the fact that you own stock or share in a particular organization. Please, as you join, please confirm you can hear my voice and you can see my screen clearly. So what you get to earn monthly or quarterly or yearly, depending on the company, the stock, the share, or the ETF, or the mutual fund, or whatever it is the invested vehicle is, it's called the dividends. So, and I said that the reason why we are trying to understand what stock investing is, especially in 2023, it's because it's one of the major source of dividends. We can also earn dividends from many other things, but one of the most pronounced, most popular source of dividends in 2023 today is stock investing. So what is dividend investing? Dividend investing simply means you are investing in that company, in that shares, in their stock, basically, purposely, because of the monthly or quarterly or yearly return or payout that the company pays to their shareholders or to their investors. So if you're on Zoom and you can hear me, please let me know in the chat box. If you are on YouTube, you can hear me, please let me know. Please let me know. Please let me know. Thank you for joining. You can always drop your question as we proceed because I don't want to miss any question. So dividends are payouts that a corporation makes to its shareholders. So these dividends can be paid monthly. Some pay monthly, very rare. Most pay quarterly, and a few also pay yearly. So let's quickly talk about the types of the two broad category of stocks that we have. We have growth stocks and we have dividend stocks. So what are growth stocks? What are dividend stocks? Growth stocks are stocks or companies that are focused on growth. What do I mean? The profit they make are focused on reinvesting back into the business to grow the business bigger and better. And a dividend stock are the stock that share part of their profits with their company. Now, we cannot totally say a company is growth or dividends as much as we can give examples. For example, now, one of the major popular dividend stocks today is Coca-Cola, and one of the major popular growth stocks today is Tesla. Tesla is a growth stock. You also see between these two examples, you also see 8 differences. So Coca-Cola has been in the market for a long time, while Tesla is just a young organization. So this also says that if you compare Microsoft and Tesla, because they are in the tech industry, so it's a fair comparison. Microsoft is old, Tesla is new. So Microsoft have built itself to a point where they can apportion a part of their profit into profit sharing, into dividends paying, while Tesla is focused on growing growing and growing for now. So the benefit of you investing in growth stock is capital appreciation. You can invest in a growth stock. So few years ago, Tesla went from, I think, 200 in just 1 year, 200 to like 800 or so. It is only a growth stock that can do like that. Not so. It is just important that we know the difference so that we can know what to target when you are making your dividend portfolio. The next thing I want to talk about, just in passing, aristocrats. So what are dividend aristocrats? Now, these are companies that have consistently increased their dividends for at least 25 years. That is massive. Imagine a company constantly increasing their dividends payout year on year for at least 25 years, and in some cases 50 years. In fact, if you do your research, you will see companies that have been paying dividends for over 100 years. That is the kind of company you want to build a dividend portfolio with. It gives you rest of mind. Remember, the name of this event, the name of this session is peaceful investing. You don't want to do an investment that puts your mind, that make you lose your, peace of mind. The next thing, so what are the steps you need to take when, investing? You need to determine how much your living expenses, and add a little more. So for example, if you live in Nigeria, look at how much you spend month on month. If $1,000 is okay, let's say yours is $800, you have $200 to you, that's roughly $1,000. If you convert that to Naira, that's roughly 700 to 800 thousand naira living expenses per month. So your goal would now be to create an investment for portfolio that will generate $1,000 dividend for you monthly. So which means that if your dividend comes in quarterly, so you are looking at a dividend that will come in $3,000 quarterly, so that you can split it into $1,000 monthly. So I hope that is clear. Living expense, you need to settle that. Then you need to now save money and invest. Find a broker that allow you to invest in global stock and ETFs in Nigeria. So we have a lot of them currently. You can, the likes of Chaka, the likes of Trove, the likes of Bamboo. You can invest, you can deal with all of these guys. And one thing I need to also clear, with you is that you need to understand that all these three organizations I mentioned, Trove, Chaka, and Bamboo, they use the same broker. They are linked to the same broker in the US. So you have nothing to lose. You have nothing to be scared of. And let me emphasize this point by telling you a quick story of how Passfolio used to be my preferred, investment platform for stock. But recently, they closed business, and then they moved their client to another company that that is connected to their to the I think Drive Wealth. Drive Wealth is the name of the broker in the US that's connected to Drive Wealth. So what I'm saying is, even if God forbid Bamboo close shop today, or Chaka has an issue today, your money is still safe with Drive Wealth. You just have to move it to another organization that works with Drive Wealth in the US. So the next thing is to find a broker, yes, and then find the right dividend stock or ETF you want to invest in. So talking about ETFs, which is the first and easiest way for any newbie to start in dividend investing. So you can look at VOO, which is Vanguard, Vanguard ETF tracking the S&P 500 index. You can look at JEPY, which is a little bit risky, but because it has high dividends, you can look at those two and many more in that category. You can look at SCHA also. It's an ETF that you should look at also. You can look at few ETFs also from Cathywood Investment ETF. You can look at the Hack Investment ETFs. They have a couple of them, a good length of them. You can look at them and check out a few of those things. So after that, all you are required to do is build your portfolio. So the next thing I want to look at is I want you to see few things you need to look at when you are investing into when you are investing into, when you are creating a dividend portfolio. The first thing you need to look at is dividend yield. So what are they paying out in terms of dividend yield? Look at the example we have here. So the stock price of this particular stock, which is McDonald's, the stock price as at when this document was done was 254. The stock price was $254.59, and then so to calculate the dividend yield, it is stock price, which is in this case $234.59 divided by the dividend percentage. So if you do 234.59 divided by 5%, you are going to get the amount you are going to have when this dividend is being paid out. The next thing I want you to look at is payout ratio. It is not only okay for a company to pay you dividends, and let me also say that the one we just checked now has a dividend yield of 5%. You can have between 3.5 to 5%, and in some cases a bit higher. But then higher dividends does not necessarily mean that it is safe or it is the best. You need to also look at their payout ratio. So what is payout ratio actually? Payout ratio is the amount, it's amount in percentage that a company is paying out to investors, to shareholders out of their profit. So if the company pay 30% of their earnings as dividends, that means they have 70% left to reinvest in the business, which is cool. And if a company pays 80% of their earnings as dividends, that means they have 20% left to reinvest, which is also good. But what you should watch is, does this company have money to keep paying out dividends? And do they have money to reinvest in the business? You don't want to put your money in a business that will soon run out of money, or does not have money to reinvest into their business. The next thing I want you to look at is dividend yield, that means dividend history. Just like in every relationship, either it is a job relationship, you apply for a job in an organization, or you want to date a person, you want to look at their history, look at how they've been performing and all of those things. You need to look at all of those things. Yes, you need to. So you need to look at, you need to watch out for consistent dividend growth. So to look at this, just type the company you want to research on Google, and then type, for example, McDonald's dividend history, macro trend. Macro trend is one of the platforms I use for research. So this data you're actually looking at is from macro trends. So you want to look out for dividend increased. Look at this for McDonald's. They kept increasing their dividends. The only time the dividend drop was in 2008 because of recession. And then after that, it picked up again, and they kept going and going and not going. So you need to watch out for that. You need to also look at their business model. The next thing we need to look at is business model. So for business model, you need to look at competitive advantage. A good example is to look at the industry and look at the company that, as much as Warren Buffett, does not do tech. He does not invest in tech companies as much, but still invested in Apple because it is just so awesome, so standing out. He noted that Apple has that competitive advantage. Apple is in the game of its own. Apple has what they call the business clout. He has that followership, that cult-like followership. Something like it has that addiction. That is what I was looking at. His customers are addicted to it. Look at Coca-Cola, same thing. And that's why Warren Buffett is one of the highest investor, if not the highest investor in Coca-Cola today. And Tesla, you can see that I put asterisk on that and Tesla because Tesla is still developing. It's a young company compared to these two that we have mentioned, still developing. So let's go to the next thing. You need to look at their top line. So what is happening to their revenue? Is it growing? Are they expanding? Are they generating more income? So you need to look at their revenue. So the next thing you need to look at, their bottom line. What is their, there's a difference between profit and revenue. So you need to also look at their bottom line, which is EPS, that is earning per share. You need to research that and look at how much they are earning per share. You need to understand this to be sure that these guys are truly making money, they are making profit. The next thing we need to look at is the management. Charlie once said that you want managers with integrity and talent. You need to look at this thing with the eyes of an investor. Will you invest in a company that is managed by people without integrity? Obviously no. So you need to look at who is the CEO of this company, who are the management, who are the board, what are they, what have they done, who are they, you need to do all of that and make sure that you are investing in a company where you believe the people that are at the top of affairs in the organization. So a quick way to invest. So for a new person that is just coming into dividend investing world, what can you do? A good way to be safe out there, before you get your feet, solid on the ground of dividend investing, is to use what I call the mirroring tactics. That is, look for notable people in the industry, look at what they are doing, understand why they are doing it, and then mirror it. So simple. So what? So simple. So look at what Warren Buffett is doing, mirror it if your goal is his goal, or if you are more of a dividend investor like what we are currently talking about, look at what PPCN is doing, look at what Dividend Sensi is doing, and then understand why they are investing and what they are investing, follow them on every platform and see what they are doing, and then you would be on the safer side. So summary, how to research, a quick way to research the company to invest in when you are considering dividend investing. The first thing is the dividend yield. Then you look at the payout ratio, you look at the dividend history, you look at, business model, top line, bottom line, and the management. Those are the 7 key, 7 key pillars of dividend investing. 7 key pillars of dividend investing. So you need to look at all of these things and be sure that, they are solid before you get into dividend investing. So for example, if your running expense monthly is $1,000, as we said in the example, you need a dividend ETF or a dividend stock that can pay you that amount monthly, since most pay quarterly. So times 3, that's $3,000 quarterly. So you need to look at how much of this stock or how much of this ETF do I need to earn, do I need to buy before I can generate a dividend of this $3,000 quarterly or $1,000 monthly. As much as that might be a huge number, it is not a game of days or weeks or months. It's a game of years, game of decades. But you want to get to a point where sometimes in your life, regardless of what your current income is, you can afford to live without thinking of, without having to work. So your work becomes an extra to hit. So that is where the goal, that is what the goal is. The goal is to get a point where your living expenses are totally taken care of by your passive income. And this is not what you will achieve in a day or in hours or weeks or months. It is something you will achieve, that will take you decades of hard work, saving, dedication to it, but it is worth it. And then you will have become a better person along the way. And then you will have, the time freedom that comes with investing. Remember, it is about peaceful investing. It's about investing in vehicles that will not take your peace of mind away. To enjoy the so what is the essence of having time freedom and you don't have free peace of mind? So here we discuss peace of mind, we discuss investment, we discuss issues in the financial market that can add to your bottom line. Thank you so much for joining me this evening. We'll be having another session sometimes in this month. I'll push it out and let everybody aware of it. After this video, after this stream, we'll make available this this presentation and this live stream so that you can go over it again, ask your question, and let's keep engaging. So if you have any question so far, please drop it in the message box. I can see you guys. Okay, drop your message in the message box, in the comments box, and let me read and answer all of your questions. I'll be waiting while I get back to the music. I'll be waiting for your questions. So you can also drop your question on the WhatsApp group. I will answer every question. I will answer all of your questions. Thank you so much again for joining me tonight. I really appreciate it.